Hi friends, this is Ramsy. Hope your preparation for F7 is really fulfilling, is really a lot more interesting now in this COVID period. This session I'm going to cover the first few units of F7 ICCA financial reporting. See, let's start it this way. I say I have a diamond and I got the price at $10 million. Now, what does it appear to your mind immediately is like whether Ramsey has got a real diamond, whether that is worth $10 million. So these two questions appear into your mind. They ransack your mind. Now, what we do is like, you have the $10 million and I have this diamond. So you agree to buy, but not until and otherwise you get yourself satisfied that I have that particular piece of diamond whose worth is $10 million. So we both agree to go to a laboratory to test it. Now, what is the rule or the role of the laboratory? They are going to test whatever the sorts of tests they have, the physical, the chemical properties, or the biological elements present in it, and they're going to rate it with a grade, color, gradient, and so on. Once they do a test, they need to adhere to a certain set of framework. Now, I'm not going to pass on this entire diamond to a laboratory and then wait at my place because that is a piece of diamond that's going to cost me $10 million. And neither would you be able to pay all the $10 million into my account and wait for me to give you the diamond because it could turn out to be nothing. So you are very skeptical and I am too. So we both depend on an external agency who does this basic testing. Now, this is how framework goes. They have a stipulated set of rules, regulations, and laws, which actually shows you like how a piece of diamond is actually tested and a report obtained. Basically, that particular report, when it is presented to you, you take it to your consultant in your country and then you find whether the report is actually dependable, whether you can take a well-informed decision of buying the diamond for the $10 million. Now, this is how accounting framework also works. Now, if I say my balance sheet worth is like $100 million and I have equity of $50 million, you are not going to just agree or buy my words. What you do is like, you need an agency, you need an agent, you need one particular person who's highly learned about how these tests and procedures are performed, like in that of a library to certify a piece of diamond. Similarly, an organization worth of $100 million could be worth much more than that in real time because I'm talking only about $100 million in terms of assets. You need to match the rest of the revenues and sales that it could generate. So basically, a chartered accountant, before certifying those financial statements, which includes balance sheet, profit loss account, cash flows, fund flows, statement changes in equity, and OCIE, when they issue this piece of documents, these documents together, what we call them as reporting or financial reporting, they give it to you. Who does it? That's the job of an ICCA. Now he signs underneath the balance sheet to tell you, yes, these informations are correct. Now, how do I come to a conclusion that these informations are correct? I cannot sit at home, basically look into my computer or laptop and say like these informations are correct. Every accountant, whether he's in the US or Australia, the Canadians or the UK ones or the Indians or anywhere you call it, they need to have a set of guided principles, and that is what this framework is all about. Basically, certain accounting standards may not be suitable for all the countries, but without those standards, no balance sheet is acceptable. So why do you need these framework? It is like the testing procedure. I need it because I cannot prepare a balance sheet that suits only my country's laws and rules and regulations and leave it to you to interpret it for your own. So that cannot be. So you need these tests, you need these framework so that the stakeholders, the creditors, the equities, the equity holders can take a well-informed decision. And how do they take it? They depend on two characteristics. One is the qualitative characteristics, and the second part of it is enhancing characteristics. Now, how do they go with it? They make sure that the materials presented in these financial statements are free of error, neutral, complete, verifiable, and they present material fact. Besides, these enhancing characteristics include comparability, because I need to compare with the previous year's performance. Timeliness is that based upon one particular accounting period. Verifiability, can I verify these statements somewhere else with somebody else? And understandability means how a creditor or a shareholder can understand them. So what is present in the financial statements? That's the next part. Your assets, which is economic resources, which otherwise we call them as increase in assets, or let's say like decrease in assets. So economic resources, economic claims are nothing but your liabilities, and equity. Now, what do you call as incomes is the change in the economic resources and claims, namely an increase in asset and decrease in liability. So results in equity, excluding the equity payments and receipts. Similarly, an expenses part is those that results in the reduction in the value of assets and increase in liabilities. So other changes in economic sources and claims can be called as due to the contributions or distributions to equity, or the exchange of assets for any other considerations other than cash. Now, what guides me to present certain assets in an order, and how do I consider them? So I need to recognize an asset based on the economic value, the benefits that it is going to accrue to me over the next few number of years of period. So which means they are relevant, and when I say that particular asset is an asset recognized in the balance sheet, it means that it has benefits, and those benefits are faithfully represented, which means I measure them properly, either based on the historical cost, the date of purchase, or the current value. Now, if I use a current value, you pretty well know that it is not based on the going concern concept. So if I tend to de-recognize them because of they do not give me any more economic benefits, then I de-recognize them. When I present them in any of these financial statements, I have to give you the relevant information, the comparative information, besides that classifying the place where I need to put. Because for some organization, an inventory, okay, could be some other organizations non-current asset. So how do I disclose them? Because my basic primary business nature tends to give me what could be the current asset and what could be the non-current asset. I need to segregate them or aggregate them, summarize them, put them in the profit loss statement and a comprehensive statement. Now, IFRS 13, which applies across the globe, gives you three different approaches: the market approach, the cost approach, and the income approach. Above all, you need to understand whether that particular asset belongs to level 1, level 2, or level 3. Now, level 1, which means that it is easily ascertainable because you have identical assets in the market. Level 2, which has become obsolete, and which has become obsolete, and level 3 is that those assets which are unabsorbable in the market. So therefore, you use like level 1, level 2, and level 3 for assets. Similarly, non-financial assets also have certain attributes based upon which alone you can assess them. Now, they need to be physically possible, legally permissible, and financially feasible. And based on this, you prepare financial statements that underlines two basic assumptions of entire accounting framework: accrual basis, going concern basis. If it is not based on going concern basis, which means that the chartered accountant is very clear that the organization does not have the ability to run for a very long time, which means a shareholder might take a second thought about investing in such a company. Not just for investment, could be for a sale out too. So a framework basically guides you into how a balance sheet is constructed and how any reader across the globe can get sufficient, relevant, complete information. So think about it, extrapolate to the real world, you will find a lot more interesting. ACCA F7 is made easy at Leader. Thank you.
Leader International for a career in accountancy and auditing.